that is going now. And so we are going to be seeing, I think, a collapse, if you like, in the precious metals derivatives system. And that'll spread into other things like other commodities, energy, other metals like copper and so on. So this is a very interesting time, if you like. So those two things, I think, you've got systemic risk globally within the banking system. And I mean, to some extent, other jurisdictions, G7 jurisdictions, or even jurisdictions which are not in the G7, if they're tempted to bail in as opposed to bail out a bank, then they're going to create an awful mess. I mean, that could be a real crisis. So we've got very difficult times ahead, Patrick, and I think it would be very foolish to ignore them. Well, eventually, yes. I think, you're in Singapore, so you're probably closer to the real story than we are. But it is clear that China is preparing herself to protect the yuan against a Western fiat currency collapse. This is why it has opened vaults in Hong Kong and also opening vaults in Riyadh, in Saudi Arabia, and will also have gold to yuan exchange facilities throughout the ASEAN trading bloc, also BRICS, and also the Shanghai Cooperation Organization. In other words, China is preparing itself to back the yuan with gold, at least for trade settlement purposes. I don't think they would extend this to citizens, as was the case under the British gold standard in the 19th century. I think they're looking at a sort of, if you like, a modified Bretton Woods system centering on the yuan. And that's the way they're going. The only thing we don't know is that roughly what the exchange rate will be. At the moment, it was floating, but it will be fixed. It will be fixed because the dollar's purchasing power over the next 18 months to 2 years, I think, is going to change radically in a downward direction. And the same for all the other currencies that are tied to the dollar. So G7 is not looking good at all. It really isn't. All those currencies are looking very, very vulnerable to what's ahead in 2026 and 2027. Well, there's a bit of profit taking, but not hugely. It had got to the point, I think, where the shorts, the establishment shorts, bullion bank trading desks and so on and so forth, could see that the markets were vulnerable to a shakeout. So they shook it out. And, amongst my Substack subscribers, I know of some who were shaken out, despite me saying, look, for goodness sake, don't trade this because you'll get slaughtered. Just stack. And, I'm glad to say the vast majority of them do that, but one or two of them on the edge have really got caught. And I don't know when they'll get back in because they're thinking like investors. This is not an investment story. This is a protection story. It's not a question of trying to, accumulate wealth. It's a question of protecting wealth. That is the key to understanding really what is going on and what and how you should react to what is going on. Protect wealth, and protecting wealth basically means getting into real money and getting out of credit. Just get out of credit as much as you can. The ups and downs in the market then become completely irrelevant. That's the way to look at it. But it was interesting that this shakeout has actually occurred at a time when gold and silver were not overbought at all. If you look at indicators like mechanical indicators, like the relative strength indicators, then it was overbought. But, if you look at actually what was happening in the market, like open interest in these contracts, the open interest was sort of slightly below the average, which tells us that speculative activity is not that great. So the shakeout wasn't going to really shake out an awful lot of stale bulls, or bulls, if you like. That just didn't happen at all. I mean, it's interesting that the first sign of metals recovering from this sudden shakeout, you've got people getting back on board quite quickly in COMEX. I mean, the open interest in COMEX yesterday on provisional figures jumped something like, 12, 15,000 contracts. So you can see that there's an awful lot of people thinking, oh, we made a mistake. if you see what I mean. This is not an overbought market. It is a market which has been rising on the establishment being squeezed all of a sudden, because nobody really in the investment management field has actually owns gold or silver. I mean, the level of exposure, just looking at ETFs and making a few assumptions about bullion, level of exposure is about 0.5% of all portfolios. This is not excessive. But the problem in terms of liquidity is that people are beginning to realize that, the performance of gold and silver is knocking the Magnificent Seven tech stocks into a cocked hat. They're in the wrong things. So they're going to have to move out of those stocks into gold and silver, just purely, on demand for performance basis. But the problem there is to increase average exposure by 1%, only 1% in gold, involves the purchase of 25,000 tons. So how does this get resolved? The answer is it only gets resolved at far, far higher prices. Now, that's an investment management analysis. It actually backs up the correct analysis, which is very, very different. And that is, it is the value of fiat currencies coming to a conclusion, an end. We're looking at the end of the fiat currency system, and their values will decline until such time as the central banks who issue these currencies actually take the means to secure the value of these currencies. Now, what that basically means is you've got to tie it to gold. There's no other option. But, if you look at the American situation, they've spent the last 54 years denying that gold is part of the monetary system and that it has been replaced by the dollar. They are all intellectuals, sort of macroeconomic, Keynesian or monetarist intellectuals who actually don't understand economics in the classical sense, which is the only sense that really matters. And so, how does the whole system, if you like, which is based on fallacy, turn around? It's not going to turn around quickly. And of course, the problem is that, when you got a fiat currency, things are driven by politics. And when they get driven by politics, effectively, central bankers are powerless to take the right action. They're not getting the right advice from all the PhDs they employ. And not only that, but they wouldn't be allowed to take the right actions by their lords and masters, who, I know all this stuff about central banks being independent, don't believe it. At the end of the day, they are political appointees, and their lords and masters are the politicians. And the politicians basically cannot step in and sort things out. I mean, the only way they do that is basically when their currencies lose all their value. And so what's that mean? It means that, the dollar goes down to zero. It's, there could come a point along there where, there's enough of a mandate from the public, or President Trump, if he's still in office, to actually authorize the correct action to fix the value of the dollar to gold, to turn things around. But the man's a spendthrift. He's got to turn around completely. And he's not a person who accepts blame for things easily. He's not a man who says, oh, I got it wrong. We have got to get this right. No, he's a man who basically, like Captain Carpenter in the poem by I can't remember who it was, an American poet. You just battle on until he's dead. I mean, and so we can begin to sympathize, if you like, with Rudolf Hammerstein, who was the head of the Reichsbank in Germany in the early 1920s. There is no option. There is no option. So we know where this is going. You just got to look and understand. That's where we're going. It's the end of the fiat currency system. The end of the fiat currency system basically tells us that it ends with fiat currencies being completely worthless. It's a process that can be stopped, but I just cannot see that there is the political will, the political mandate, and the intellectual understanding of the advisors to actually stop it. So I assume it's going down to zero until I know otherwise.